Hey everybody, good to be here. My name is Brent Moores, and boy, it's been quite a week. We're going to do this and wrap up the week here for us. A lot of volatility. You guys probably already know that, but we're going to look at some of that, look at the week ahead, and we'll do that in a sec. I'm sitting in, by the way, for Ben Watson. For those of you expecting to see Ben here, Ben's off on a workshop right now in Scottsdale, so I'm sitting in for him this week, but just glad you're here. And I'm also glad Cameron May's here. Cam is helping me out in the chat, so as you have questions, feel free to type those into the chat between Cam and myself. We'll try and do our best to help you out here. You can follow Cam and myself on X at Brent Moore CS, at Cameron May CS. Now, before we get too far into this, let me just remind you of a few disclosures. The information today is for general informational purposes only and should not be considered an individual recommendation of any security strategy or chart type. And let's see, well, I don't know we're going to deal with any options today, but let me just say this. Options do carry a high level of risk and are not suitable for all investors. The paper money software application, though, is for educational purposes only. And past performance is no guarantee of future results. We'll be doing a fair amount of technical analysis today. That is looking at charts. But technical analysis is not the sole means of investment research. All investing involves risk, including loss of principal, and there's no guarantee of an execution of a stop order that is going to be at or near the stop price. What are we going to do? Well, we're going to do the same thing that we do each week in this class, and that is we're going to look at the general trend of major market indices. We're going to talk about some of the things that move the market this week and general trends, different time frames, support and resistance levels, potential targets, look at individual sectors, what sectors are hot and what are not, and some news items out there. And so that's where we're at. All right, let's head on to the Think or Swim platform here. Okay, you guys all know, let me just zoom in here a little bit. So this is the week. We finished up with actually a kind of a bullish day, and we could break this down. Of course, let me just get rid of this left-hand column here. We could break this down and look at a 1 day, 1 minute. And this has been a roller coaster. Each day this week, it seems like we've done this thing where we go up and down and up and down. Well, one thing you like to see after kind of not a good week is you like to see it finish up on a strong note. Now, it could have been stronger, but as we got in towards the latter part of the day, so this is mountain time for those of you who are wondering, yours will show a little different, maybe if you're in a different time zone. But we had about 3 hours of a nice rally there, and then it kind of petered out, and I was worried right about here that we dropped out, but we actually closed off fairly strong. And that's kind of a key consideration. When we look at this, let's look at this S&P 500 here. I'm going to edit this 20-day, and I'm going to make it a 200-day moving average here real quick. So let's make this a 200-day. That's going to be the red line. And you can see where that 200-day moving average is. This is an area that we haven't hit for a while, right? I mean, for a long time. If I go to a year, let's go to a year chart here real quick. Here's a year chart. Here's the 200-day moving average. When was the last time we haven't touched it in the past year. We haven't even gotten close really in the past year on that 200-day moving average. Well, that's where we came to, and that's probably a relatively important support level. Now, who knows whether it's going to hold? I don't know. But what I'm saying is, this is how we want to finish off the week. Jerry said a lot of weak finishes this week. Yeah, this was a week where we finished weak. We had a couple stronger ones, but what a lot of traders may consider is like, if I'm looking for bullish, we probably want to see some confirmation of that kind of a hammer candle. Now, one question that sometimes occurs on this is, hey, we've had this pullback, we've had this drawdown. In fact, let me do this, and let's just kind of, I looked at this just a couple hours ago, but let's see what kind of pullback we've had. So at the bottom of the day, we were down about 8% almost from the peak. But right now, we're down closer to 6%. So that drawdown isn't as bad as it certainly could have been. Now, this is the S&P 500. Sometimes you get this divergence between what the S&P 500 is doing and because it is influenced by a few big stocks, and what, say, the S&P 500 equal weight is doing. If I can click on the right thing here, I want my styles. So let's just see kind of a comparison of the S&P 500 versus the S&P 500 equal weight. I think I have equal weight in there already. I do. Okay, so the purple line right here, so this is a 9-month chart right now. The purple line represents the S&P 500. The blue line represents the S&P 500 equal weight, where all 500 stocks have an equal say, right? Kind of a democracy here on the S&P 500 equal weight. And you can see there's times when this has diverged fairly substantially. In terms of the pullback that we've had, here's the S&P 500. You can see the equal weight has not pulled back as much, but over the last 9 months at least, the net result is they're pretty close to one another there on that, okay? So let's move on and let's look at let's look at another time frame. Well, let me just go back and let me just switch this to let's take a 3-year chart. In the grand scheme of things, and hopefully this makes you feel a little better, because I know this has been a week that's kind of worn on people. In the grand scheme of things, the market's gone up for a while, right? 2022 was a pretty poor year for market performance, but this doesn't mean that this is going to turn, terrible or anything like that. We saw a pretty good pullback here in mid-2022, and so we'll see. Let's look at the NASDAQ now. So here's the NASDAQ. NASDAQ tend to be higher beta stocks, and so therefore we tend to get more pullback, further drawdowns on those higher beta stocks. And we can compare that to, again, let's do that 200-day moving average on that NASDAQ. Here's the 200-day. We actually broke below the 200-day moving average on the NASDAQ. When the NASDAQ outperforms it, or when the NASDAQ goes up, or when the markets go up, the NASDAQ tends to outperform the S&P 500. And when it goes down, the NASDAQ tends to underperform the S&P 500. Let's look at one more major index here, and then we're going to look at some other stuff here. Okay, here's the Russell 2000. Very different chart. I mean, we looked at that. Let's look at a year chart. We saw how strong it was on both the NASDAQ and the S&P 500. Totally different chart when we factor in small caps. Small caps from their high, high up at 2466. That's not. I'm going to have to change the scale here to even get our drawdown on this. On small cap stocks, we're down like 16, 17%. So they have struggled a lot more. Part of that could be, let's just talk about why. There's some concerns about economic softness right now in the markets. Small caps tend to be less financially strong companies than large caps. Large caps grew big because they've been strong. Small caps, they may grow more. That's certainly possible, but generally they have less cash on hand. Generally they have more debt on hand. And so small caps tend to underperform when the market has hit some uncertainty. Speaking of uncertainty, here's the VIX. Let me zoom in. Here's the VIX right now on this. So you can see this is a 1-year chart on the VIX. Well, actually, no, it's not. Let me zoom out and just change time frame here we'll do a proper 1-year chart. There's a 1-year chart on the VIX. And I've kind of highlighted some spiky areas on that VIX where it came up. By the way, there's a survey link in the chat here. And it really spiked up last midsummer or whatever. I don't even remember what hit it, got it all the way up to 65, but you can see, well, when it's gone up, it hasn't remained up. But this, compared to where it's been, it has been fairly elevated. These are the most elevated points that we've hit, plus that. So how long it's going to last, I don't know. But I guess if you were to look at what we did today, this is just kind of the opposite the market, which has been going down, and we got kind of a positive candle there. We had a nice lowering of the VIX today here in the markets, maybe some easing of jitters, and we may be able to see that in a certain, in some other ways here in terms of people having concern for the market. Let's look at the US dollar, dollar sign DXY. This is the US dollar. This is, I'm going to go a little shorter term here. Here's the drop we've had. We've had a weakening of the US dollar. Now, that weakening of the US dollar may help some US, like multinationals, in the sense that it will make their goods more affordable for their international clients. But it does describe, it is showing some, less desire, I guess, for the dollar among other countries. Some of it could be concern about just economic concern in terms of uncertainty. But also, if you look at interest rates, here's the 10-year yield. We've had it, and this is, if you pulled up that dollar chart side by side, you'd see it drop very similarly to this. So we've had this pullback in interest rates here. And that's, I know for a lot of people, that's a good thing. In fact, let me take a quick excursion here. We'll get back to interest rates, the 10-year rate in a minute here. But let me go to the Analyze tab, and I'm going to go to Economic Data. And I don't know how many of you are familiar with this page, but you can pull up Economic Data, and I'm going to go to interest rates here. And I want to go to mortgage rates. They have a mortgage rates one here. There we go. Here's mortgage rates. We're going to go to 30-year average fixed rate. And this is, whenever you use this, you got to be aware of the time frame it zooms out to. I mean, this is going out to like a 50-year time frame here on this. I don't want that. But so I'm going to zoom way in. So here we're zoomed in, and you can see where mortgage rates have gone up, and some of the concerns in, say, housing right now. Well, this week, mortgage rate applications shot way up. Why do you think that is? Well, people are like, who are interested in refinancing or buying a home or something. They're going, well, is this ever going to happen? Or am I just going to have to accept this rate that's up near 7% for a 30-year? Well, you can see we've actually dipped a little bit. Now, I don't know where the future of this is going. We'll look at the Fed Watch tool maybe to help us a little bit, but keep in mind, this is a 30-year mortgage rate. If I go over here, this is a 10-year. These are on the longer side of the curve, long into the bond spectrum. So you may go, why doesn't the Fed just lower rates? Well, it doesn't always work that way. Last time the Fed lowered rates, this is what happened to the 10-year. So there can be a disconnect between the short-term rate and the long-term rate. But let's do this. Chairman Powell spoke today. Okay, so this kind of anticipated. What was he going to say about the future of interest rates? And I didn't actually hear. I just saw a summary of kind of what he said. And the gist of what he said was that there's enough uncertainty right now in our economic policy, maybe good, maybe bad, or whatever. But he is having a hard time projecting the future interest rate policy or future monetary policy, basically, for the Fed, given the volatility or the uncertainty that we're going through. But as there is more clarity going forward, he'll be able to give more direction on that. So how is this effective? Well, this is our Fed Watch tool. This is using Fed Fund futures, trying to find what the Fed fund rate is going to be. March 19th was just, a couple weeks away, or actually less than that. Current rate is 425 to 450. Basically, Fed futures are kind of banking on it not changing. About 97% chance of it not moving. Okay, let's do this. Let me go out to the end of the year. So here's December. So let's look at rate cut possibilities here on the Fed funds rate through the end of the year. Remember, the current rate is 425 to 450, which is right here. The highest probability, right here. That would be 1, 2, 3 cuts by the end of the year. Now, can this change? Absolutely, this can change. In fact, you can kind of see the uncertainty. I said this is the highest possibility, but it's still only showing at 32%. But something else I want to point out is just yesterday, so I think this is probably mostly because of the comments of Jerome Powell. Just yesterday, we've seen a little bit of shift in this. Look, the odds, so these were yesterday's odds. And what you can see in terms of this would be more rate cuts up here and fewer rate cuts down here. You can see the fewer rate cut end of things went up. The odds of that, a little bit at least, odds of that went up. Whereas the odds of the bigger rate cut actually kind of diminished a little bit. Now, Jerry said, this is a good graph, but it changes quickly. Yeah, it does. Absolutely. So that's why I kind of tried to disclaim it and say, I wouldn't bank on this happening or whatever, because this certainly changes. The Fed has always said we're data dependent. Yeah, and we've seen that. They are. And in fact, even more than being data dependent, to reiterate that, Chairman Powell's saying right now, hey, look, we got to wait on this and see. Now, there's some asset classes this could be affecting as well. Let's look at oil. Here's oil. What's oil done? Oil has gone way, way down. If I go back to a longer period of time, let's go back a year. Oil right now, let's go back to 3 years. How about? Let's go back 3 years here. Here's 3 years of oil prices. Here's kind of where the low has been on oil over the last 3 years. Where are we right now? We're almost there. So I don't know if we're going to break through that or not, but people, if you foresee less demand, less robust growth in the economy, then you would expect oil to be weak. If you see a turnaround in economic activity, we'd probably expect to see oil to rally. I don't know there. And of course, there's the supply end of things as well. I'm just talking from the demand end of things. But right now, oil is very low. Let's look at another big asset class that some traders are interested in. Gold. What's gold done? Well, gold is like, we hit an all-time high yesterday, it looks like. Oh, no, that's last week, I guess, on that. Yeah, we're off a little bit of that, but boy, not much has been stronger than gold right now. And gold is, often seen as kind of this, flight to safety. If you're concerned about the stock market, you're concerned about the valuations, concerned about bonds or whatever, gold may be a potential choice for you. Now, let's talk about some things that occurred this week in the markets, because that's what we do in this class. We look at what happened this week, and we look about what happens next week. I think from the market standpoint, in terms of economic reports, the biggest thing, the economic data probably didn't help the markets this week. But I'm not sure the economic data is what really hurt it that much. The biggest difference, most significant report, it came about because of the difference between what was expected and what came in. And that was Wednesday. We had the ADP non-farm payroll report, which was not even close. It was a big miss. I don't remember the exact numbers on it, but we're supposed to have like over 100,000 jobs, and it was like 50,000 or something like that. It was a big miss. That added to the narrative that we are seeing weakening in potential weakening in the economy. And that's a little bit of a concern to people. But I would say the biggest reason for the drop, it seems, and I certainly can be wrong, is just kind of jitters with the uncertainty of policy right now. We're kind of wait and see on policy. And so people are concerned about that, coupled with this, perceived weakening in economic data. Okay. So George in the chat said, whipsaw on U.S. policy changes decreasing confidence. Yeah, it comes down to consumer confidence. Now, having said that, next Friday, we have a consumer sentiment report coming out. University of Michigan Consumer Sentiment Report. That comes out next Friday. So that'll be interesting to see. Now, before I get to next week's, let me just mention, we'll stay with the economic reports. Next week, we have JOLTS on Tuesday. We have CPI on Wednesday, which is likely a kind of a biggie. PPI on Thursday. We have our weekly jobs report Thursday, and then we have consumer sentiment and inflation expectations, University of Michigan consumer inflation expectations on Friday. So which is going to be the biggest mover? Probably the biggest surprise is going to be the biggest mover. Whatever it diverges the most from what is expected to what actually comes out. Having said that, inflation is a concern. It's been a concern for a while, and it has not gone away from it as a concern. So CPI and PPI are reports to look for next week. Now, in addition to economic reports, of course, we had earnings. There's a few big companies that came out with earnings, and I'm just going to target S&P 100 type stocks here. Poor Target. Target has not done well, and they had earnings. They actually beat on both the top and the bottom line. But there is concern about the future growth, number one. Excuse me. Number two, right now, if you watch the news, they have this boycott, like a 1-month boycott or something going on. I don't know how much that's affecting this. Target's up about 1% today, so that's not terrible. But that was an earnings where this is an example of where actually you can look at the numbers and they beat top and bottom, but the stock dropped. It just shows that it's the top and bottom line is not everything. Okay. Other companies that announced earnings this week that were bigger movers, Broadcom. So AVGO, Broadcom here. And you can see they went into it with a nice, pretty strong downtrend. Nice, strong report though. Good Q1 reports, good Q1 results, but their Q2 guidance was good. They guided for a stronger Q2, and that really is probably the bigger mover here in the markets. And the other one occurred last night, and that is Costco, which is getting destroyed today. Here's Costco. These guys beat on the top line. They missed on the bottom line. But let me show you this. Let's look at the history of Costco reports, which may give us some clue as to numbers that weren't like terrible misses. I didn't see anything horrible in Costco's report there to really, warrant necessarily a 6% drop here on this. But let's look back, let's look at that Analyze tab, and let's go to earnings, and there's Costco. And this is, we don't have the numbers here this was just yesterday. But what you see is, as you look back in time, is Costco tends to beat. Okay, they tend to beat their numbers. That is this yellow line compared to the green line. The green line is the estimate, yellow is the actual. So if you have a history of beating, it probably has a bigger impact on when you do miss, that it is probably going to have a bigger move against you there. So that was that week. Now, what about coming up this coming week? Well, we have a couple bigger earnings reports coming out. Now, we're not really in earnings season anymore. So there's just not that many out there right now. But the two biggest next week, Oracle, you can see it has struggled. In fact, breaking below potential, we were probably hoping for some support kind of in this area here. I don't know. We'll see if that holds. The jury's kind of out on that one here at this point. But this is Monday morning, I think we have Oracle coming out. And then Adobe is another company, kind of sideways on Adobe, but if we know anything, earnings is something that can knock something out of its sideways range there. So let's take a look let's kind of shift focus to sector performance here. Of course, we can look at sectors today. This is the heat map for today, and you can say it's a nice mix today. Like yesterday, this was like almost all red. There's a few exceptions. But here we have this mix, and you can always see this is a kind of a nice thing, and this actually looks a little different than it did earlier today. It changes. IT, relatively strong. Microsoft, not so much, but a lot of green there in the IT. Industrials, energy, strong. Utility, strong. Healthcare, pretty strong, other than Eli Lilly. But you can say that's today's action. Okay, but what I'm more concerned about than today's action is, how these sectors fared. So I'm going to pull up this watch list. Now, this watch list, by the way, for those of you who aren't aware, you can get this public watch list, S&P 500 sector indices. Okay. Now, don't confuse the two. They're both valuable. This is sectors and industries. This breaks it down more. Here, we're just talking about those 11 sectors right there. So I'm going to click on that. And then if you just do that, it's not going to be helpful. So I say this a lot, those of you who watch me. The symbol probably isn't going to help you much. So add a description column in there so you can see what it is. And then what we can do is we can scroll through. But what I want to do is I want to look at relative strength here on this. So I'm going to add relative strength. And just a reminder for those of you who are not aware, relative strength just is basically telling us how this is doing compared to the S&P 500. Okay, so we've broken down the S&P 500 into 11 chunks here. And how is this compared to the average, so to speak? And the way we're going to tell is we're going to look at what the slope of the line is doing. So if we're looking at energy right now, what's it doing? Well, it's been kind of going sideways, up and down, but basically sideways. Energy has been pretty average here. Now, over the last 6 months as a whole, we started, that red line represents where we started. It's actually underperformed the S&P 500. But lately, what have you done for me lately? We're going to say lately is the last few weeks, basically going sideways here on this. So that's something to consider. Let's look at another one. Materials. What are we doing? Well, mostly sideways, maybe creeping up a little bit. So when we're looking for sector performance, you can see this. Industrials, maybe turning it around a little bit here on industrials, some more strength in industrials. And that's a nice, big bullish engulfing candle today on industrials. This is not staples. This is discretionary. And how have discretionary stocks been doing? Well, for the 6 months, they've been doing good, but lately they have not been doing as good. So if you're looking for areas of the market to invest in, you may consider what the sector strength is, because although you may be able to find a consumer discretionary stock that is doing very well right now, there's probably some. The theory is if its peer group is doing worse, doing poorly, it's harder for that stock to continue to stand out. So if you're going to take that approach to the market, and this isn't, this could certainly change tomorrow, then this may not be a group you would be as interested in. Compare that to Staples. Here's Staples. Well, Staples is going up. Staples is a more defensive sector. Staples is a group where it's probably less susceptible to, if we have economic slowing, that people still are going to buy their stuff, the stuff that they need, what we call staples. You're seeing strength there. So that could be an area that you look at. Now, George said, when the SPX goes down, the sectors might look good even when they're doing nothing right. Okay, I'm not sure if this is what you're getting at, George, but let me kind of address this. This is relative strength. This is how it is compared to the SPX. So let's say the SPX is going down, 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 and this sector is going, we'll make it blue, is going down, but not quite as poorly. What's the relative strength going to look like in that case? Well, in that case, the relative strength would actually look up, because we'd be outperforming. Even though it's going down, it'd be outperforming. Now, when you look at this, the sector is actually doing okay here in this case. And same thing with healthcare. Healthcare has been doing pretty good. And also keep in mind, it doesn't mean every stock is doing well in that sector right now. In fact, we saw Eli Lilly's getting whacked today, and they're in the healthcare industry. Financials, they've taken a pretty good tumble lately. But part of that may be interest rates, kind of a switch in interest rates here recently. IT, we saw today, some of those IT stocks were looking pretty good, but we're looking beyond just a single day's move in these. And in general, we've seen a lot of weakness in IT here on this. And just in general, when you have higher growth sectors, okay, generally we'd probably consider information technology to be a higher growth sector. Let's see. Did I get the symbol? Yeah, there we go. So here is S&P 500 pure growth. Let me just change this chart just a little bit here. And let me go to, I'm going to make it a percentage chart. Okay. So we're going to show this price as a percentage. And let me go to a 3-month chart. What have growth stocks? So this is pure growth stocks. There's different growth indexes and there's different value indexes. Some of them will take, say, the S&P 500. This is we're talking about S&P 500 stocks here. And there's some stocks in the S&P 500 that are characterized actually kind of both as growth and value. Okay, they can have characteristics of both. There's some that are just purely listed as growth stocks and some that are just purely listed as value stocks. This pure growth index here is just looking at those that are purely listed as pure growth stocks. Okay. And you can see over the past 3 months, down about 9%. But if we were to narrow that down even further, I think it would probably look, I haven't looked at this, I'm guessing, let me make this a 1-month chart. I'm guessing it would probably look even a little worse here. Yeah, down about 11%, almost 12% over the last month. Let's compare that to value stocks right now, okay? So these are pure value stocks. So instead of down 11%, value stocks have actually increased 1% over the past month period of time. So you can see that shift. You can see a shift in value growth. For the most part of the last couple of years, growth has outperformed value, no doubt. Right now, it's just the opposite. And you can see that reflected in those sectors there that we were looking at. Those sectors that are more growthy sectors like information technology, typically higher beta sectors, by the way, have been underperforming. And if you're purely like a momentum or relative strength, short-term relative strength, then that is going to, that'll inform you on what you may do. Communication services, not so hot. Let me just go back to that relative strength graph I had. You can see been going down the last few weeks. Utilities going up a little bit. Real estate going up pretty significantly. Real estate, healthcare, consumer staples would probably be our strongest three sectors right now. Now, fitness and dance with I don't know if I'm saying that right, is which is more important, when relative strength is above the red line or the trend of the relative strength graph? Here's what I would say. It's a good question. So the question is, we got this red line right here, okay? In fact, I'll draw over it in red. If I can keep my hand, usually sometimes I'm not the best drawer with my mouse here. That's the red line, okay? So the question is this: which is more important, where this is in relationship to the red line, or where what the slope of this is, basically? I'd say for our purposes, where we're trying to focus in on this part of the chart over here, this is what matters. Where it's sloping, what the current slope is what matters on this. Now, if I were looking at this is a 9-month chart, if I wanted to go, well, overall over the last 9 months, what's better, then you can use that red line there. But for the shorter term stuff, I would probably ignore that red line. That'd be my take on that. But, everybody has their own system there for doing it. Okay, so we can see where some of those areas of strength in the market are right now. And that may inform you on some things to do. Now, let's talk about some stocks that are in the news today. We had some upgrades and some downgrades. Tesla. Let's pull up Tesla. Tesla, which, boy, you guys, probably are well aware of the story on Tesla here. Let me go to that. We'll go to our normal. We're below a 20-day moving average. We're below a 50-day moving average. It's sold off. I don't even know why. I'm not going to take the time to figure that percent, but we're not quite at a 50% sell-off, but that's probably like a 40% sell-off or something like that. That's a huge sell-off in Tesla. They were actually upgraded today by TD Cowen as an analyst from a hold to a buy. Why? Well, I didn't read the report, but I'm assuming valuation has something to do with it. It's a lot cheaper to buy right now than it was to buy in December. There was an article in the Wall Street Journal I saw that they had mentioned something to the effect of, and it's talking about something probably a lot of you have thought about yourself, is there may be a little bit of political stigma with Elon Musk and Tesla's now that could be detrimentally affecting the stock price on that. And whether you're pro Elon or anti Elon, I don't care. That's up to you. But the stock may be paying the price. For that. But they had an upgrade. Okay. In fact, George said, that's what George was saying basically. That what I was kind of getting at. Upgrade doesn't seem to have changed the stock the stock at all. Another company with an upgrade. I'm just, obviously there's a lot of companies out there with upgrades and downgrades, but I'm just picking some of the bigger names that you are going to be familiar with. Baird upgraded. Bank of America from neutral to outperform. Again, doesn't seem to be helping the stock price that much there. Sometimes when you get an upgrade coupled with a good earnings or something, that tends to move it more. Not doing much for this stock here right now. And let's do one more. JP Morgan, upgrade. This is from Baird as well, from underperform to neutral. Not helping the stock at all, almost down 2% today. Here's a downgrade. Okay, here is a downgrade. Macy's, it's perfectly opposite. Like we saw those upgrades and the stocks were doing poorly. Macy's, JP Morgan downgraded from overweight to neutral, but you see it's coupled with the earnings. So the earnings is the bigger factor here on this. And so I don't know if this is going to continue or not, but that's a nice 6% jump on earnings there. All right. Let's see. Let me check on time. Okay, we're running low on time. Let's just look at a few other big stocks. I know Alex said, hey, let's look at Mag 7 stocks. So let's do it and take a look at a few of these. There's a few that have actually really taken a pretty good tumble here. Here's Meta. I mean, we looked at the S&P 500. It had dropped, about 7% or something like that, 6-7%. From high to low, this was like 18%. Little recovery now, 15% drop in Meta. I think we saw a relatively similar drop in Netflix. That's getting hit pretty hard. See what we got on Netflix here. Here's Netflix, about a 16% drop there. So not all Mag 7 stocks have been terrible though. Apple's held up pretty well over the past few weeks, okay? High to low, well, even the low of the day was only about 5%. By the end of the day, down about 4%. So Apple has outperformed recently, even though before that it was underperforming. Just a reminder, there is a survey link in the chat. Let's look at maybe two more here. Let's look at Microsoft. How's that faring? Not so hot. Microsoft has been in a strong downtrend below our 20-day and our 50-day moving average. Now, we talked about a lot of things, and I just want to do one more thing before we go. The market's struggling right now, but it doesn't mean there aren't pockets of strength. We looked at several sectors that are stronger, and you can look within those sectors for potential opportunities, of course. Another thing you can do is you can look at things like, say, we looked at different charts. We looked at oil, and that was struggling, wasn't it? But we also looked at gold. And this is just the gold future, and we're not going to trade any gold today, any gold futures or anything today. But keep in mind, if you see something like, hey, gold, we know that it's been strong for a while, and maybe your perception is, I don't know if it's true or not, maybe your perception is gold is going to continue to trend up, then what you may do is you may start to look at individual stocks that may be highly correlated to the price of gold or whatever it is that you're looking at. And so if you wanted to, you could look at a company that is kind of dependent on the price of gold probably, and there's other factors in it that can determine its price. But you could say, hey, maybe I want to take a shot at this and buy something like that. Just an example, this isn't a recommendation. Potential resistance there? Maybe, and if that's the case, you could consider a buy stop if we break above that resistance line, or you could just go in and say, right click on it, I'm going to buy it, and just buy the stock if you wanted to. And say, I'm just going to throw that trade in there and put that in the portfolio. Market's closed, so that wouldn't fill today anyway. But there you go. Everybody, thank you for joining me today. I think Ben's back next week. But in the meantime, have a wonderful weekend. Thank you, Cam, for helping me out in the chat, of course. And everybody make sure you subscribe to the Trader Talks channel. And we'll see you all next week. Bye-bye, everybody.